I'm with Bloomberg Intelligence, and I had the honor of presenting for this venue, Futures Forward, in New York in the spring. They didn't invite me to London. I hope wasn't something I messed up, but we're doing it again. Just as we're getting the strategy, my panels, my presentations ready. So I'm a former member of the CME. It was the Chicago Board of Trade at the time. Used to trade in pits in the 80s. And the stuff that Max was saying tonight and that Benjamin was saying and everybody else is just, when you're in the trading pits, I used to be on the phones with all institutional customers. It's the stuff you live and breathe, and what Daryl is saying, you hear it every day, and you live by it. But one thing I remember, a key lesson I learned in the trading pits was, number one, get there early. I used to come in, take the first train in, because if you get there early, you get the customers in London. If you don't, the guy next to you will call your customer in London. And the lesson I learned really early on was futures are the most liquid place in the world. And I learned that from my London traders. I used to say, you're trading in London. Got the clicker for me? Thank you. Why you come into the Board of Trade and at the time, now it's the CME, to do these options trades? And even why don't you do it electronically? Because it all went electronic. It's because the liquidity's there. And I remember being able to get markets that were just so tight. Sometimes we could get bids above offers, and that was rare, but that was in option spreads. So what I do at Bloomberg, I'm with BI, Bloomberg Intelligence, and I'm going to dig into some charts and things that I publish on the terminal. I'm going to start out with a very complicated thing. I'm going to talk about things like backwardation and futures curves and open interest. And that's why I want to start out with this complicated slide. See the gold line? That's a measure of the futures curve. The curve means the front future minus the last divided by the front. This is a sign where that curve's moving is what matters to me. I'm a strategist. My goal is to say, this is where the market's going. And by the way, I'm going to be right and Daryl's going to be wrong. So in this case, what you see here is this is a futures curve on the entire Bloomberg Commodity Index weighted, heading towards backwardation. That's a bullish sign. That's a positive sign for commodities. Again, I'm a commodity strategist. And in the meantime, at the bottom, you see in magenta, open interest is increasing, more and more position. Open interest is when you're a trader in futures is one of the first things you need to look at is open interest, because that means liquidity. It means you can get out, and you have narrow spreads and things. Open interest increasing is also in the white line. That is managed money net positions. Basically, it's hedge funds. This is net positions, and they can get long or they can get short. In this case, you see the little lines I drew there on the bottom. For the broad commodity market, right now, currently, positions are the least long they have been since that low that we had last year. So I'm bullish commodities for that reason. Yes, we've had this trade issue. I look at it very simplistically. We've had a trend in commodities. Commodity prices are up. We've had a dip. They've corrected 10%. They did last year. Keep it simple. I wouldn't go all the way on that. Buy dips in the trend. The white line I want to point out here is just the commodity market's underperforming stocks. That's going to change at some point. I don't know when. Maybe Daryl can help me with that. But overall, that's the strategy. Markets had a dip. And for commodities not to recover from these levels by the end of the year, that's a pretty significant statement on a global macro negative situation, which I think is less likely. So I want to dig in a little bit to some more specific markets. This is one of my favorite charts, and you probably all heard it, this massive short. It's the big short in U.S. Treasury futures, bonds, 5s, 10s, and also we have the ultra-long bond. I did not show that here because the history is not as long, but see this position here is a percentage of open interest. 15% of all positions are short. That's the most ever since 1995. Okay, so that means that bond yields are less likely to spike. There's a massive short base in there. At some point, you need to clean those out, and or it's somewhat bullish for bond prices. In the meantime, you have a significant indicator for yields, copper gold. A lot of you have heard of that indicator, watched that indicator. It's a good indication for where yields are going. Yields recently in the U.S. picked up above 3%, but copper gold, which is a high correlation, that's just the spread between copper divided by gold, is pointing the other way. Something's got to win. To me, the key missing link there is copper and the dollar. And that's an axe I have to grind. I'll point that out in a little bit. Copper just looks too cheap. This is a chart that brings us back, that we might bring out in the panel a little bit, to Lehman 10 years ago. See the gap? That's a chart of the Bloomberg's Industrial Metals Index. It's all based on futures. And see, that's the last time we had a monthly gap was 10 years ago, almost at the exact same levels. It's a sign of a selling extreme. But we have to judge for ourselves, is it worthy of this type of correction? I don't think so. The market's had good support. I look at it as a selling extreme as a buying indication. That's my job. I'm supposed to make the call without making the call. I have to be careful with compliance. So I look at that indication to me as the market's had a selling extreme for a good reason, but is probably overpriced for the risk. Industrial metals to me look like a buying opportunity here. Here's an indication. Copper. I have to point to copper because even with Rishad today, I had a live TV interview. I point out that's to me my main axe to grind at commodities at the market at the moment. Copper to me is just too cheap for this environment. It's corrected 23%. Guess what crude oil did last year? It corrected 23%. That was the bottom, and then it rallied 80%. To me, it looks just that same way now. It's in a support zone, but key things to look at from a future standpoint, what's the information we can glean from the futures market? Net positions on CME traded copper right here are priced for a bear market. And my thought is like, good luck with that one, because we might get a bear market. But we need a good catalyst. We've already had a good catalyst. But now that we're down, we're in support, it's priced for it. In the meantime, that little magenta line, that shows you the value of copper divided by industrial metals overall. So copper's just getting beat up. Another key thing is the dollar. The dollar's been strong, but that's been a copper issue. Gold. So this is where Daryl and I have to disagree a little bit, and maybe we can debate this. I'm bullish on gold. And this is why. And you'll be wrong, but maybe you'll be right. We'll see. We'll check this one a year from now. Exactly. Well, it's about stops. That's the key thing in futures, how you manage your risk and your stops. So in gold, we have gold, but the key thing I want to point out here, something a lot of you might not have seen, is volatility. That's the measure of 90-day, I think I give 90-day volatility in the gold futures. It's the lowest it's been in 20 years. So when volatility gets that low, what does it take for it to go up? The opposite of what it took to go down. So gold has been ticking down. You saw in Daryl's chart, it's been ticking down slowly. When it goes down the same amount every day, that's not volatile. So what it usually needs to do is to reverse. Probably go up. Or it's got to collapse. I don't see a collapse in gold. And in the meantime, see that little magenta line? That's managed money net positions on CME traded gold. It's the most negative in the database since 2006. So everybody's short gold. Not everybody. Yes, there's stuff behind it. Yes, there's options. Yes, there's OTC. I can't measure all that. If you want to do options, you have to do them delta weighted. It's complicated. This is a simplistic indication of how short the market is. Last time we had something similar was here. That's right when the Fed tightened. That was the bottom. So gold, to me, should go up. It's the one commodity I want to go down, because I look at gold as, if gold goes up, it means the dollar's not doing well, and it's probably a pickup in U.S. volatility, in U.S. stock market volatility, which is way overdue. But this is a bullish indication for gold. So how many of you have seen a backtest? We all love backtests. How many of you have seen a backtest that doesn't look good? Okay, you don't have to answer, I understand. But I like to, when I'm being from the indexing business, I always like to say, so, we need the data history. I always like to ask, well, I want the data history for next year. And they always look at me like I have three heads. And I say, well, this is what I'm doing here. I put out this deck a few days ago. This is where gold should be a year from now. And I'm looking at 1,400. Yes, it's a bit of a bold statement. It leaves an analyst left, it could be high risky. But I look at it this way. In the white line, you have the U.S. trade weighted broad dollar. And I use that instead of the DXY because that is 22% rated in the Chinese yuan. It's a Federal Reserve. It's not calculated. It's not widely traded. But from a commodity background, long-term history standpoint, it's the highest negative correlation to commodities. Why? It's trade weighted. That's at that high or very near that high. I look at that as diminishing returns. It needs to go higher for gold to go down. I think it's more likely to mean revert. The catalyst, I don't know. What you see in the blue line is Fed tightening. Gold has been in a bull market despite Fed tightening. There's a potential end game there. If the Fed ends this or slows down, that's a pretty bullish sign for gold. And I look at gold near good support at around 1120. I think that's a similar level you had. And it's more likely to just pop up to near 1400. And as you saw in the earlier chart, it's quite ready. So let's go to crude oil. The bull run's probably over. The most of it, majority is. That's not kind of more of an obvious statement. I like to look at this as a chart since 2011. We're basically right in the middle, 70. The stars aligned to 70 in WTI. But the key thing is to look at that top line. That's the futures curve, the one-year futures curve. I always use the one-year curve because there's no seasonality. It's the current future versus the future from a now, and it's in backwardation. Backwardation means that price now is higher than the further out contract, which means demand is in excess supply. But it's not so much what the exact level is, it's the trend. This is basically the same as looking at demand versus supply. The trend's been up, the market's been bullish, but look where it is. It's at the peak from 2014. There's not a lot of room left for crude oil to go up. So I look at crude oils. It might get near 80. Everybody's going to get excited. It'll probably take a geopolitical event. It's going to get everybody bullish, and guess what? That'll be a good peak. It might get near 60. That would probably take some kind of global economic issue. Everybody's going to get bearish, and it should go back up. So I look at crude oil as stock for a while. WTI, that is. For Brent, you just add 10. I want to just do a quick overlay. That line on top is the same one here that I showed there. This is backwardation in white. In yellow, in green, to prove what I showed you, that's the simple measure of demand versus supply from the IEA and EIA on a monthly basis. Another key thing is stocks to use. In futures, not so much futures, but in commodities, it's always very important to look at stocks use. So it looks like it's bottoming, similar to what we saw in 2013 and 14. So everybody's heard the story about the U.S. Space Administration tried to develop a pen to bring to space, and the Russians just said, we used a pencil. Exactly. I love that story. That's what this chart reminds me of. This is the pencil indicator of what's happening with U.S. supply. The biggest factor in crude oil is look at that green line. That is a measure, a 100-week average of managed money, of commercial short contracts, commercial shorts, producers, U.S. producers, anybody that's producing WTI and hedging it. That's where they're doing. It's an indication you're not going to hedge something you ain't got to sell. And that's just an indication of what's happening. The line in white is U.S. supply. It's an estimate from, I think that's the EIA estimate. 2 months ago, that little white line was flat. And we pointed this chart out. The TV guy got sick of me. He said, Mike, we've seen it like 10 times. But I have to show you, this is an indication of what's happening in the world. The massive supply, every time you hear estimates of U.S. Oil supply, you look at this chart, they should be revised higher. And that's been the trend since we started showing this last year. Natural gas, one of the most volatile commodities there is. It's ripe for an explosion. First of all, when you say natural gas in backwardation, which means the front contract is higher than the back, it's an oxymoron. When I was at S&P and I managed the Goldman Sachs Commodity Index, the only index I ever had to rebalance was the natural gas index, because it's always in contango, and you have to roll that future, and you lose money rolling. Natural gas in backwardation is a sign of demand exceeding supply. And then you see the narrowest 24-month range in futures history, which is since 1989. The market's ready to explode. The market's indicating upside. It needs a catalyst. I don't know what that will be. We can always guesstimate. I thought it might be a bit of a steamy, hot summer, and that hasn't happened yet. But there's a market ready to break out. What's the path of least resistance? Typically, when markets get this compressed, certainly commodities, they might trickle down, but the upside or the downside is limited. We'll get into grains a little bit, and then I'm kind of getting towards the end. This is a key indication that the grain market's bottom. That's important because it's the number one measure for food in the world. And what you see in white is the opposite of backwardation. That's a one-year measure of all the grains in the Bloomberg spot index in contango. It's the most extreme contango we saw last year in almost, 11 years. So look what happened when it reached the extreme. The market took off. Another little extreme here. The yellow line, the market took off. Same thing here. This year, we've had a near-perfect storm for lower prices in grain prices. The number one thing that measures these are globally traded, but they're delivered in the U.S. U.S. Corn Belt, which is where I'm from, had the best year of production ever. So that's a supply factor. The trade war, obviously, soybeans, the epicenter of the trade war. Soybeans getting hammered. Does it make sense that copper is down more than soybeans? No, that's part of the reason I'm bullish copper. But the key factor here is we've had a near-perfect storm. The market's indication it should go up. We just get a little tweak next year, a little bit of normalization in weather, which a lot of us saw in Europe this year, which showed up in wheat, a little bit more of that. One thing you can expect in weather, you can't predict it, but you can expect volatility. This market's due for a pretty significant bottom. So that's why I look at the overall commodity markets. Bottom, energy is pretty much run out. grains are ready to go, and metals have a lot of room to the upside. So first, I would just want to show, putting a little technicals on it, which you would call, is this technicals or charting? There, I just want to make sure, I'm just checking. So this is just a, in magenta, stocks to use in the grain, stocks to use peaking is a bullish sign. We have the narrowest range, I think I'm using a 4-year range here, or is it 5-year? 5-year range ever. That's pretty long. For the Bloomberg Grains Index, the market's stuck in a narrow range. Path of least resistance is up. It needs a little bit of a catalyst. And despite the fact that we had a near perfect year for lower prices, they didn't go down. So I want to talk about the mighty soybean. Soybeans are the most widely traded of all agriculture futures. And the farm I used to own was one of the main things that the farmer planted. I have to admit, I'm not a farmer. But what you see here in the orange line is backwardation. It's a measure of the curve. I'm sorry. This is a measure of managed money net positions, near the shortest ever. So everybody's short soybeans. And it's very rare this time of year to be short soybeans because the crop's done. And the market's at pretty good support. For a good reason. It's down because of the trade issues. So I just want to dig in a little bit with corn and move on to one of my other subjects. This is me predicting corn should go up next year. Despite the perfect storm, corn is actually not down. Again, that range is very narrow. What you see in the white line, that's the best year ever for corn yields in the Corn Belt. It just, you don't get better. And we haven't get 181 bushels per acre. Just look like a few years ago, we were around 140. It's unsustainable. It just takes one little weather event, and that can pop down to 140 to 150, and grains and corn will double or probably double in value. Typically, it's just a matter of time. So one of my favorite subjects as I get towards the end is cryptos. This chart was a bit of a blessing and a curse. Everybody knew cryptocurrencies were obnoxious last year. We all kind of got that. But we got lucky enough to pick the peak within a week. 3 key things. Futures were launched. Now, the futures volume in terms of cryptos is not really significant. It's psychological. The futures means cryptos are going in mainstream. So how many people here have been exposed to the masses having life-changing wealth? It just doesn't happen. But the select few can do it, and they have. So the futures came about. In the meantime, the one key thing that we found that Bitcoin was negatively correlated to is Fed tightening. Now, I don't have time to dig into the history of Bitcoin, but it's really designed as a opposite for the dollar. Something to help make up for quantitative easing and those things. So every time the Fed tightening, Bitcoin went down. So you add those 3 together. There was a frenzy, futures were launched, and the Fed all tightened in December last year. Poof, that was a peak. The problem is, as a strategist, now they call me McGlone in the space. So we launched the Bloomberg Galaxy Crypto Index. So the guy who manages it calls me McGlone. I'm like, I'm sorry, I'm just Mick Right so far. What I show here is just basically that white line is just the price of Bitcoin relative to its 60-day average, and the one in gold is gold relative to the 60-day average. And the call was obviously sell Bitcoin, buy gold. So far, that's worked on the Bitcoin side, and I just want to point out now, here's the chart. The problem with being a strategist and riding a bear market, which I'm doing in this case, is people blame you. I came to New York in the 90s from the pits by calling the bull market in the bonds, which was a lot more fun. But in this case, what you see, I just want to point out why we should not see a low in Bitcoin for a while is some simple things. Volatility. Volatility should go lower, particularly because there's futures. There's potentially options. There's more and more participants. There's lots more competition. They're arbing out the volatility. The market needs to go to lower volatility. And typically, it only bottoms when volatility is low. So I think the last time we had a new low in volatility was October 2015. At the same time, that was 1 year worth of supply. If you just look at the amount of new coins launched, were actually unchanged and started dipping down after a year. Supply down, volatility down. October 2015, Bitcoin was up 26%. That started the rally that ended in December. That's what we need, and we're so far from it. I don't know what it's going to take, but I point this out. I had a lot of meetings this week. I've been in conferences, and I do get death threats sometimes for these. Just making a call. It's just making a call in Bitcoin. So I want to end on this slide. The one key thing about I think that's so important in this space is adding adult supervision. And the CME was the first, CME and the other exchange, CBOE, I don't want to mention that too much, was the first futures to do that. But this is an indication of our prediction from very, very beginning was the world's largest futures exchange, the future is going to win. And this just is a simple, usually only one contract does. This is a simple indication that the CME Bitcoin futures are winning. That's a chart of open interest. We mentioned that earlier. The number one thing in futures that you want to look for, one of the things when you're trading is make sure there's open interest and or potential for it. And open interest is growing on the CME contract, and it's flat to actually declining on the CBOE contract. So market's migrating towards the CME futures.